When Uber launched in Africa in 2013, it seemed unstoppable. The global giant had unlimited resources, a proven business model, and a first-mover advantage. It was supposed to dominate the continent's ride-hailing market for decades. But then, a 19-year-old dropout from Estonia entered the race, with just a €5,000 loan from his parents. Within 3 years, his company had beaten Uber in Nigeria, Kenya, and South Africa. Today, Bolt holds 21% of Africa's ride-hailing market, compared to Uber's 16%. This is the story of how a teenage founder from one of Europe's smallest countries outsmarted Silicon Valley's biggest player. In 2013, Markus Villig was a 19-year-old high school graduate in Tallinn, Estonia. While most teenagers his age were starting college, Markus was building a taxi app in his bedroom. He borrowed €5,000 from his family, money they'd been saving for his university education, and started recruiting taxi drivers on the streets of Tallinn. The app was called Taxify. It was simple, scrappy, and built on a radical idea. What if a ride-hailing company actually cared about its drivers? Markus had grown up watching Skype transform Estonia into a tech powerhouse. His brother Martin had worked as a software engineer at Skype and would host hackathons, where Markus, usually the youngest participant, learned to code. The message was clear: world-changing companies could be built from anywhere, even a small Baltic nation. But Markus wasn't interested in competing with Uber in San Francisco or London. He saw a different opportunity. While Uber was fighting regulatory battles in New York and Paris, entire continents were being ignored. Eastern Europe and Africa had massive populations, growing middle classes, and terrible taxi services. These markets were desperate for better transportation. In 2016, just 3 years after launch, Markus made his move. Bolt expanded to South Africa, Kenya, and Nigeria. Uber executives barely noticed. They were too busy fighting over lucrative Western markets. That dismissal was their first mistake. Uber entered Africa with a Silicon Valley playbook written for San Francisco. Premium pricing, strict vehicle requirements, cashless payments only. The company assumed what worked in California would work everywhere. But Africa wasn't California. Credit card penetration across most of Africa sits below 2%. Uber's cashless-only policy immediately excluded the vast majority of potential customers. Meanwhile, Bolt supported both cash and digital payments from day one, making the service accessible to everyone. Uber required newer, higher-end vehicles that most African drivers couldn't afford. Their strict vehicle eligibility standards limited the driver pool in countries where car ownership itself was a luxury. Bolt took the opposite approach. They allowed older cars and implemented flexible vehicle policies, dramatically increasing the number of drivers on their platform. Then there was pricing. Uber charged drivers a 25% commission on every ride. In markets where drivers were earning modest fares to begin with, that commission ate deep into their income. Bolt slashed their commission to just 15%. For drivers, that meant earning 10% more on every single ride. The math was simple. Switch to Bolt, make more money. By 2020, Bolt held over 60% market share in Nigeria, Africa's largest economy. Uber, despite its global dominance and billion-dollar war chest, had been outmaneuvered. Bolt's victory wasn't about technology or capital. It was about understanding the market. While Uber made decisions from boardrooms in San Francisco, Bolt's teams lived and worked in African cities. They experienced the infrastructure challenges, the payment realities, the regulatory complexities firsthand. Uber focused on major cities like Lagos and Abuja, targeting premium customers who could afford higher fares. Bolt took a different approach. They expanded aggressively into second-tier cities like Ibadan, Benin City, and Enugu, building loyal customer bases in markets Uber had ignored. By the time Uber realized these cities mattered, Bolt had already locked in the market. The commission structure became Bolt's most powerful weapon. While Uber maintained its global standard of 25 to 33% commission, Bolt kept rates at 15% across Africa. In some markets like Egypt, Bolt even waived commissions entirely for the first few months to attract drivers. The result was dramatic. Drivers flawed to Bolt. More drivers meant shorter wait times for riders. Shorter wait times meant more satisfied customers. More customers meant more ride requests for drivers. The flywheel spun faster and faster while Uber struggled to compete. Bolt also mastered regulatory navigation. Nigeria's regulatory environment is notoriously complex, with rules that change frequently and enforcement that varies by state. Uber's global compliance model, designed for predictable Western regulations, struggled to adapt quickly. Bolt took a localized, proactive approach. They worked directly with local authorities, adapted to regional requirements, and built relationships with regulators. This agility kept them operating smoothly while competitors faced service disruptions. By 2024, Bolt operated in 30 African cities across multiple countries. The company had raised over €2 billion in total funding and reached a valuation of €6.3 billion. Markus Villig, who dropped out of university after one semester to focus on his taxi app, had become Europe's youngest self-made billionaire at age 27. But Bolt's success extended beyond Africa. The lessons learned in challenging emerging markets made the company stronger everywhere. As Markus explained, if you can make the business model work in difficult, price-sensitive markets with poor infrastructure, then entering developed markets like London or Paris becomes materially easier. The unit economics are better because prices are higher and the operational challenges are smaller. Today, Bolt serves over 150 million customers across 50 countries. The company operates ride-hailing, food delivery, grocery delivery, e-scooters, e-bikes, and car-sharing services.
It's Europe's first mobility super app, all built from a small office in Tallinn. In recent years, even Uber has begun copying Bolt's strategies. They've lowered commissions in select African markets, introduced more flexible vehicle requirements, and expanded cash payment options. But the damage was done. Bolt had already captured the hearts and wallets of African drivers and riders. The story of Bolt versus Uber in Africa reveals several critical lessons about global business strategy. First, local knowledge beats global capital. Bolt succeeded not because it had more money, but because it understood African markets better than its American rival. Second, treat your suppliers well. By offering drivers better earnings through lower commissions, Bolt built fierce loyalty that no marketing campaign could buy. Third, go where your competition isn't. While Uber battled over premium customers in major cities, Bolt quietly dominated second-tier markets and built unbeatable network effects. Fourth, adapt or die. Uber's insistence on applying its global playbook without local adaptation cost them market leadership in Africa. Fifth, frugality is a feature, not a bug. Bolt's lean operations and focus on profitability from the start gave them staying power that venture capital-fueled growth at all-cost competitors lacked. As Africa's ride-hailing market continues to grow, projected to reach $7.8 billion by 2030, Bolt's early advantages compound. They have the drivers, the riders, the brand recognition, and the market share. Uber is still competing, but they're playing catch-up in a race Bolt has been winning for years. Markus Villig's journey from a teenager with a 5,000 euro loan to Europe's youngest billionaire is more than an inspiring startup story. It's a masterclass in strategic thinking. He didn't try to outspend Uber or out-engineer them. He simply outthought them. By identifying underserved markets, understanding local needs, and building a business model that aligned incentives with drivers, Bolt achieved what seemed impossible, beating the world's most valuable startup at its own game. The lesson for Africa and for emerging markets everyone is clear. Global dominance isn't inevitable. Local companies that truly understand their markets, treat their stakeholders fairly, and execute with discipline can defeat even the most powerful international competitors. Uber came to Africa expecting easy conquest. Instead, they met a scrappy Estonian teenager who proved that in the battle between global capital and local knowledge, smart beats big every single time.